folks, it's another great day of earnings as we talk about first here Walt Disney Corporate. You know Walt Disney. You know Disney. This stock down 4.5% in the after hours trading. So that right there shows you there could be some bad news about this earnings report. We're really in the point of in this market right now where earnings reports basically are life or death for a company. There aren't really subtle moves. The market is incredibly volatile. So if you were to miss, you are getting absolutely schmammered. If you beat, you may get schmammered still, or you might go up. There's just not much neutral going on right now. Even out of incredibly big companies too. It's pretty crazy what's going on right now. But let's look at this earnings report. Obviously, the main thing that investors, as in your big money investors, which are impacting the stock price, they're looking for Disney Plus subscribers. That's the only thing that really matters for this company right now as far as metrics, if I'm being 100% honest with you. That's just, unfortunately, that's kind of what Wall Street does to some of these companies, and they trivialize it down to really one data point when there's a lot more going on. But let's take a look. So, non-GAAP EPS line of 37 cents. Misses by 13 cents, and a GAAP EPS of 9 cents misses by 21. Very big miss on an EPS standpoint here, which is obviously something that is a little bit disconcerting. You'd like to see a little bit better in terms of numbers there. I mean, obviously, you really would in terms of profitability. And even this, the revenue line, not quite what I would have expected here. $18.53 billion, up 26% year over year is nice, but obviously off of a weak year last year, it missed by $240 million. So I think there's several reasons why we may have seen numbers like this. Obviously, we have issues with more shutdowns, and I think overall people are maybe not necessarily going back in full force back in what they're interested in. I mean, not going back to Disneyland quite yet necessarily. We'll see what it looks like. Obviously, we can look at the parks numbers too, which will be important. Disney Plus subscribers, obviously the main key here. 118 million compared to 73.7 million in the same quarter last year. So overall, they still grew by 45 million subscribers in a span of a year, which is pretty darn significant in my opinion. Growing over 50% it's pretty big, but I guess not to the investors' numbers. 50% is just not enough growth. So let's just take a look at some of the good stuff here. Net income line, obviously one that we like to look at, and you see the change year over year, and it's obviously incredible what you see. 160 compared to a loss of 710 million. And on the year, $2 billion as opposed to a loss of $2.8 billion in the year prior. So obviously that number grew incredibly in that aspect. Revenue only increased 3%, all things considered, so not quite what you might have expected in that aspect. And again, you have to consider this quarter ends October, start of October necessarily. So technically, when you look at things, they really had 2 quarters nearly of 2 full quarters in the year of their 2020 fiscal year that were unimpacted entirely. So that's kind of where you see this balance come out a little bit more, because those are great quarters for them. Then you see the last 2 quarters of their year were a little bit rougher. So 2021 here, as a whole, is facing a little bit different of a challenge in that aspect. So just keep that in mind there. Yeah, I mean, good stuff. Segment results, obviously something worth looking at. We gotta look at all these fun things. So they aren't necessarily as detailed in the breakdown. So the Disney Media and Entertainment Distribution, which is their new category here, you see combined year over year grew 9%, which is plenty fine in that aspect because you're talking about good growth really in terms of the direct-to-consumer, which is what it was prior, which is the Disney Plus number. And Disney Park Experiences and Products naturally up 100% year over year. But if you look at year-end, actually down 3%. So again, that's because I mentioned the prior half a year for the 2020 fiscal year was pretty darn nice the first 2 quarters of that year. So recovery in the park segment not necessarily quite there, but you can see from this quarter that they're getting there. I mean, I think it goes without saying that they are going to show that recovery and really go beyond that. So next year should be fantastic for them in this segment. Should be big time. Excited about that. So, and obviously the media and entertainment distribution segment is very nice. Part of the impact why you're seeing only a 5% growth year over year when you're talking about things like movies, just not necessarily as many releases, and movie theaters still struggling, and I think that obviously impacts their revenue in that aspect. So not quite as many blockbuster movies this year in general too, which is understandable. People aren't really going to theaters as much, so keep that in mind. Keep that in mind. So obviously this is a great breakdown of what that media and entertainment distribution line looks like. We have linear networks here, declined 4% when you're talking about this quarter, up 2% year over year. Direct to consumer, which is obviously the big one we're talking about, up 38% year over year, and on the full year grew 55%, and that is obviously the big segment. And by that alone, I think this company, again, I think it deserves to trade higher than at a higher multiple than it has been historically because of this aspect. They do have a very high growth aspect, or really high growth portion of the business, really coming into the works here. You can see what a percentage of revenue this is really increasing to when you're talking about 27 billion versus 10 billion, and then you look this year and it's 28 billion versus 16 billion. So you can see how much larger of a portion of the revenue that's becoming and how that will be in the future. I mean, how that's going to take impact in that aspect. So direct to consumer also saw increases from a operating income standpoint, which is good. The net losses decreased, and that's a big aspect too, is when they can get profitability from a direct-to-consumer standpoint, because that definitely impacts their bottom line by a significant margin as it's taking over as one of their main revenue sources. That's where you see a declining EPS line for this company. So keep that into consideration. I do believe there's a chart that'll show subscriber numbers right here, which is what we want to see. And this is very encouraging in my opinion. I mean, everything I see here is quite encouraging. So you look at the Disney Plus numbers year over year, 60% growth, massive stuff. ESPN Plus, 66% growth as they continue to add content into that. That's fantastic. Hulu, if you look at the SVOD numbers here, 22% growth, still growing, and the live TV number actually declined 2%, but that's definitely a number I'd like to see improve for them as people kind of cut the cord with cable. But regardless, if you're looking at the traditional total Hulu numbers, 20% growth in terms of subscriber numbers, so that's really good. So monthly revenue per paid subscriber, obviously an important aspect too. The Disney Plus number actually declined by around 9%. My presumption is there may be free trials and offers that are really impacting that number. ESPN Plus grew 4%, SVOD up 1%, and live TV, Hulu up 18% in that average revenue, which is great. I mean, it's great in that aspect. So nothing super crazy. Here they say that lower results at the consumer products business were driven by lower royalties from the licensed game titles, Marvel's Adventures and Twisted Wonderland. That's what they're going to say there. So we'll look at that and see what that does. But you can see that consumer products line here down 3%, while Parks and Experience internationally grew 46%. And I mean, it tripled when you're looking at a domestic standpoint, 3.5 times that number. So that's where you can really see where the recovery lies in terms of the parks number here, which would be fantastic if they can increase that. back to the original status, as well as grow the Disney Plus line, because that's kind of where they're headed. So I'd love to look at the balance sheet on this company, as we love to do, as we get rid of the fluff. We get rid of the fluff in this house. So we'll be finding it very shortly, and here it is, baby. So it's a year-over-year comparison, which I do like. I do. Total current assets here sitting at $33.6 billion compared to $35.2. Looks like really just a small decrease in the cash position. Nothing too crazy in that aspect. Total assets in general did rise, 203.6 compared to 201.5. Pretty solid. What can I say? In a year, some slight growth in that aspect. We'd like to see the liabilities not necessarily grow that much, but we'll see what it looks like. Total current liabilities coming at $31 billion compared to 26.6. So that one increased, but you see a decline in terms of long-term assets or long-term liabilities. Borrowings decreased. Other long-term liabilities decreased as well by a pretty good chunk of change there. So pretty nice, all things considered, because you see total stockholder equity actually rose in the last year by around $5 billion, 93 compared to 88. So we've seen improvement in the balance sheet after a pretty rough year last year where their business was impacted heavily. And obviously you need to look at the performance of the stock the last year, up 26%. And really since 2020 year, the stock's risen up 100% in the span of just over a year. So you got to keep that into your mind, year and a half performance. But this stock's now trading at 166 in the after hours. So it'll put a market cap on this company. Really, if you're taking out that 5% of that number, which you got to take out, okay? We're talking about taking around $300 billion on the market cap, right around that number. A little bit higher than that, probably closer to $305 billion on the market cap if it opens at this level, with a very high PE ratio naturally, because of these pretty rough numbers in terms of the profitability. So if you look at a market cap standpoint, and then you look at annualized revenue, because I think it's obviously worth mentioning, and we'll scroll up to the top so you can see exactly what they posted in an annualized revenue standpoint. They posted $67.4 billion. Now this company is only trading at a market cap of $300 billion. Not even 5 times that value, with a pretty hyper-growth business within this company. When you're talking about Disney Plus, it's hyper-growth. Anything over 30% in my opinion growth, I think that's hyper-growth. And we're talking about massive recovery over the next year in terms of parks, which we've already seen from this quarter. So I look at these numbers, and I think this stock deserves to trade higher. This is, in my opinion, a $200 stock. And I think some people might find that crazy, just because historically Disney stock trades typically trades very cheap. But the core business fundamentals they've not really shifted by any means. They've added another fantastic segment onto their business, and it's just a brand that's around forever. Okay, look, I like Disney. They're keeping originals on the platform. It'll keep user growth continuing to grow here. I feel good about Disney stock at these levels. I really do. I think it's undervalued, despite the PE ratio. We're comparing this closer to, in my opinion, you should compare it to other tech companies at this point, streaming services like Netflix, and how their valuations stack up, because they're a competitor in the game, and they also have a massive physical business as well. So keep that in mind. I hope you have a great day, though.